Today, investors are mulling over data on a strong decline in crude oil stockpiles. The U.S. Department of Energy reported that U.S. crude stocks fell by 4.8 million barrels last week, while analysts expected an increase of 0.4 million barrels. In general, the situation in the oil market has improved. After a local correction, oil resumed its bullish run and returned to the area of $92 per barrel. The psychological level of 90 acted as support amid the asset's corrective movement. Thus, the only factor affecting investor sentiment remains the risk of oil shortages. In the short term, buyers are expected to take the lead and bring the price back to the $94 mark, the high posted earlier in the week. At the same time, a bearish mood still persists in the market. If the price fixes below 89.90 on the 4-hour chart, the asset's correction will continue. Otherwise, oil prices will see a gradual recovery. The long-term outlook for Brent crude is rather optimistic. After a return to the recently tested highs, traders will most likely drive the quote to the next targets. If there are no unexpected events, the benchmark may well approach the level of $100 per barrel. The situation in the foreign exchange market is rather stable. Tomorrow's meeting of the Bank of Russia acts as a significant catalyst for the pair's dynamics. The regulator is expected to continue tightening monetary policy in the face of rising inflation. True, the fact that consumer prices have advanced below analyst forecasts will most likely raise concerns among traders of the Russian currency. After all, if inflation rises at a slower pace, the central bank may not raise interest rates less than expected on Friday. However, these doubts have been rejected and the ruble has halted its slide. Market participants anticipate the regulator hiking its key rate to 9.5% from 8.5%. During its rapid decline, the dollar-ruble pair reached the support area of 74.50–74.80, where the volume of short positions decreased slightly. If the price consolidates above 75 per dollar on the 4-hour chart, a rebound followed by an upward movement is possible. Until then, there is a likelihood of price fluctuations at the lower levels. If the pair settles below the 74.20 mark, its downward cycle will continue. Gold is fluctuating ahead of the long-awaited release of the U.S. inflation report for January. If the annual consumer price growth rate is below the forecast of 7.3%, expectations regarding the Fed's rate hike may become more moderate. A higher-than-expected figure could lead to a more hawkish policy stance by the U.S. regulator. In case inflationary pressures remain high, traders will most likely shift their focus to gold, viewing it as a reliable hedge against inflation. In this case, the metal will edge higher. However, the acceleration in inflation tends to cause a sell-off in bonds, which in turn provokes a sharp rise in Treasury yields and the dollar's value. This may exert a downward pressure on gold prices. Nevertheless, despite monetary policy tightening by the Fed and now the ECB, gold is gradually gaining value. It has already overcome the barrier of $1,830 per ounce. If the trend persists, the precious metal will quickly return to the level of $1,850 per ounce. At the same time, it's worth noting that this rally is likely to be short-lived, as gold is expected to be weighed down by interest rate hikes in the midterm. So here is the forecast for today from our analysts. We hope this review will help you decide on further positions and trading strategies. Have a nice day and see you back soon. So here is the forecast for today from our analysts. We hope this review will help you decide on further positions and trading strategies. Have a nice day and see you back soon.